Okay, hello. Good afternoon, everybody. Happy lunchtime. Thank you for joining us. We are so excited to be talking to all of you today about estate gifts and planned giving at CTU, but this information also applies generally for other charitable organizations that you may be considering in your estate plans. And with that, I'm going to kick us off. Um, We'll talk a little bit about, just kind of walking through charitable giving in general, and then turning more to estate gifts. So for just general charitable tax basics, right? Cash is always deductible at face value. While gifts of non-cash assets, so capital gain property, stock, real estate, um, if you're transferring business interests or something like that in a more complex scenario, those things are going to be limited to basis or perhaps for market value, depending on what asset you're transferring. While cash is you get the full face value of the deduction. Generally speaking, taxpayers are going to be subject to some adjusted gross income limitations for deductibility purposes, but that will depend on your own sort of income, whether you're filing jointly, and then also what organization you are giving to. Is it a private foundation? Is it you know a, a a school like CTU, a church, something those kinds of things, considerations. And then on the other hand, right, so you have gifts to charities during your lifetime, and then there's this other thing called planned gifts, and those are estate gifts to charities after you pass away. So for the current tax year for 2025, there is a lifetime exemption for estate gifts, where an individual can transfer to a loved one or a family member or a friend or whomever, really, up to just underneath 14 million as an individual without incurring the estate and gift tax. Married, filing jointly couples can transfer just underneath 28 million combined lifetime in 2025. That is changing in 2026. The big, beautiful bill is shifting those lifetime exemptions to come, for transfers of wealth without incurring estate and gift tax to 15 million individually. And so that would be a combined exemption of 30 million for a married couple filing jointly. You get the full fair market deduction, for your estate tax purposes, if you transfer gifts to qualified charities in your estate plans. And then gifting an IRA can also help to avoid income in respect of a decedent, which would be considered taxable income, again, for state tax purposes. So all of this is a lot of sort of complicated and high level tax implications for charitable giving. What we're going to do now is switch and talk more about the sort of actually transferring something to a charity in your estate plan. So why do something, why give to a charity through your estate? Why not give during a life? Why do it at all? Why even consider a charity in your estate plan outside of the tax kind of consequences, right? The way I like to talk about this is thinking about it in kind of a three-pronged approach. One aspect of making a planned gift or making an estate gift to a charity is creating a lasting legacy. For many people, this is the single largest gift or transfer of wealth that they will be making in their lives. And that is a way to truly create a lasting legacy, whether that's at CTU or someplace else. You are able to really have an impact for generations of students to come, right? So doing that at CTU means that you really get to leave your mark, and again, generations of students and faculty and staff members will benefit from your generosity. The second, kind of aspect of an estate gift is the tax benefits, right? We talked a little bit about that in the previous slide. The other thing with estate gifts is, as many of us know, we work hard, we accumulate income, assets, wealth, and we want to be able to enjoy that during our lifetime. We don't want to part with that while we could still potentially enjoy it. Making an estate gift allows you to enjoy, your hard-earned work and wealth during your lifetime. But when you're no longer here to enjoy that, it again allows you to create that lasting legacy, right? And so you get to hold on to your assets during life, but really make an impact on future generations of CTU students later on. And then the third and final piece is we at CTU get to welcome you to the Way Society, which is our legacy and sort of recognition society for folks who have included CTU in their estate plans. I'm going to pause here to just sort of make a plug for sharing your estate plans with CTU. We can't welcome you to the Way Society if we don't know that we are in your estate plan. And many times we don't find out that we are included in someone's estate plan until they have passed, right? And so we can't welcome you to the Way Society and shower you with our gratitude and just our humility that you've made such an impactful choice to include CTU alongside your loved ones if we don't know that we are in fact included in your estate plan. So letting us know that we are in your estate plans then allows us to welcome you to the Way Society and steward you and your gift, so that when it is realized at CTU, we are, ensuring that we're the best planning partners for you and for your gift for generations to come. So estate giving, right? What is it? Is it hard? Do I need to talk to my lawyer? Is it complicated? What's going on with that? Estate gifts are generally some of the easiest and simplest gifts to make, right? You can make it in a will or trust with just a very simple, straightforward provision. We'll talk about some sample language later on in the presentation, but you can make it through a will or living trust. You can also gift through your estate, securities, real estate, a percentage or a residue. You can also name CTU as the beneficiary of a life insurance policy, of a retirement account, of a savings account. These are all ways that you can make an estate gift. Generally speaking, for life insurance and for your IRA, it's as easy as checking a box with the IRA or insurance administrator. For estate gifts, you'll want to have some provision in your will or trust. And again, it's just a very straightforward sentence or two, and we have some examples of that later in the presentation. But it's just truly a very straightforward way to create a legacy at CTU and to just drive impact. So here we are. Here's our sample language, right? So this would be if you wanted to include a percentage or a specific dollar amount in your will or trust to support areas of greatest need at CTU. We call those unrestricted gifts. And here you would just share this language with your attorney. I give, devise, and bequeath to Catholic Theological Union, a not-for-profit organization, the sum of blank or the percentage of blank, to be used for the general purposes of CTU. You could say to be used for the areas of greatest need at CTU. Either of those works. Here, we're talking a specific purpose, right? And so this is if you want your gift to go to support a very specific area. This is, I think, where we would definitely want to be working with you and acting as planning partners with you so that we can ensure that whatever specific purpose you have in mind, we can, in fact, use it for that purpose going forward, right? With all of the changes in terms of admissions and visa statuses and things like that right now, right? If you wanted to support a very specific student or a very specific purpose, we would just want to be in conversation with you to make sure that we could in fact administer your gift when it's received for that specific student, or the students who fit that kind of description or for that purpose. And so here, similar to the slide before, I give, devise, and bequeath a percentage or a specific amount. And so we want to include this next sentence. This is really important. As I have directed in the most recently dated separate fund agreement or written designation document signed by me and maintained by CTU, right? And that way we're both kind of working, it's sort of a hand in glove situation. We're working together to make sure that we are, in fact, going to be able to use and realize the amazing gifts that you're giving to CTU. So before we talk about IRAs, just to kind of, I think, summarize estate gifts, from a will or a trust perspective, these are, again, very just straightforward. You would like to include CTU in your estate plan. Please use this language, reach out to us if you have any questions about it. But it's just, again, typically for most folks, the simplest, the easiest, and the most impactful way to create a legacy at CTU. The next slide, and what we're going to talk about for the rest of the presentation, is IRA gifts. Those are quickly becoming the second most important, not important, second most popular way that folks are making planned gifts to charities because it's just incredibly straightforward. So individual retirement accounts, gifts of an IRA. We hear all the time, all of these acronyms, RMD, QCD, and there's numbers and figures flying around, and I know that can get confusing. So an RMD, or required minimum distribution, comes into effect when taxpayers turn 73. You are required to take a certain amount. It is based on an actuarial table. Your IRA plan administrator will kind of tell you what that is, but you have to take that money each year, starting at 73, and then that money is considered for tax purposes taxable income, and you claim it on your tax return and you pay taxes on it, right? A QCD, which is a qualified charitable distribution, can reduce your RMD dollar for dollar up to the maximum amount that can be considered a QCD in a given taxable year. For 2025, that amount is $108,000. In 2026, that increases to $115,000. So what does that mean practically, right? That means that, let's say John Smith, who is 73, has a required minimum distribution from his IRA of $200,000 for the 2025 tax year. John Smith could turn around and say, great, I would like my IRA administrator to send a QCD to CTU in the amount of $108,000, which is the maximum amount of a QCD for the 2025 tax year, right? The gift has to come from the IRA to the qualified charity in order to be considered a QCD. We don't want Mr. Smith to take his RMD, cash it for $200,000, and then turn around and make a gift of $108,000, because in doing so, he would have to claim all $200,000 as taxable income, and his QCD and the gift of $108,000 to CTU would be subject to those AGI limitations that we talked about earlier in the presentation. What we want to do, right, is allow Mr. Smith to take dollar for dollar, reducing his RMD amount by using and leveraging a QCD. So to say it again, right, what will happen is Mr. Smith will tell his IRA, I would like you to make a QCD in the amount of $108,000 to CTU. The IRA will do that. CTU will receive it. And that QCD reduces Mr. Smith's RMD requirement for the 2025 taxable year, dollar for dollar. So what he will take as an RMD in this calendar year is not $200,000. It's $200,000 reduced by $108,000. So math, hope some of the people out there can help me out. But I think that's about $92,000 that Mr. Smith is going to be claiming as taxable income and then, filing his tax returns. That's a pretty significant tax benefit when you think about, the tax liability and the delta there. So definitely, I think, a really important thing to know and to have, and to think about going forward if you're considering making estate, making gifts during your lifetime, but also then thinking about estate planning. This is a nice introduction to how those two things can work together. Before we move on and kind of talk about then gifting IRA accounts through your estate plan, a couple of things to note and keep in mind when it comes to IRA gifts, specifically to QCDs. QCDs must be made in the tax year in which you're in right now. So for 2025, that gift must be made by December 31st. And when we say made, that means the individual holding the IRA needs to alert their, fund administrator that they would like to make a QCD. The IRA needs to turn around and then typically cut a check and mail the QCD to the qualified charity. The qualified charity needs to receive the check and cash the check by December 31st of the tax year. So for this year, that would be 12/31/2025. Making sure that all of those things happen is really important because, say, for example, John Smith alerted his IRA on December 25th that he wanted to make a QCD, and the check was received by CTU on January 2nd. That would not count as a QCD for Mr. Smith for the 2025 tax year because it was not received and cashed by the qualified charity before 12/31 of the calendar year. Okay? Okay, so then let's talk a little bit about gifting IRAs through your estate. Separate from QCDs, separate from RMDs, gifting an IRA to a qualified charity instead of gifting it to a family member or a loved one who's an individual has some important tax consequences for the beneficiary, right? For your loved one. Let's again use Mr. Smith as our example. Mr. Smith has a daughter whom he loves dearly, and he has an estate valued at, let's call it $1 million. And he has an IRA valued at another $1 million. Mr. Smith wants to give as much as possible to his daughter, and he also wants to include CTU. So what does that mean? What Mr. Smith should consider doing for tax purposes for the sake of his daughter is gifting her any cash assets through his estate or trust, and then consider gifting all or part of his IRA to a charity. Why would he do that? First of all, he wants to leave a lasting legacy at a charity, right? So don't use your cash assets for that if you have a retirement account. Use your retirement account. Why? If Mr. Smith gifted the retirement account to his daughter would be required to cash the retirement account out, triggering taxable income for his daughter, which she would then have to claim. There is no QCD once you've passed on. So his beneficiary, his daughter, would need to cash out the IRA account. There's some kind of requirements and timing limitations on that for her. And then she would end up owing taxes on that, at an adjusted rate, but probably at the higher end. If Mr. Smith gifts the retirement account to CTU in whole or part, CTU pays no taxes. We would not have a taxable, trigger on that. And Mr. Smith would be accomplishing his goal of, creating a lasting legacy at CTU. So when you're thinking about, should I gift cash to the charity and the IRA to my family or loved ones, or do the opposite, in consultation with your accountant and your lawyers, I would highly recommend considering gifting the IRA to the charity and gifting cash and any other assets to your family or loved ones if that's what you're thinking about doing. And last but not least, another plug to let us know. We have this handy dandy form that you can fill out. It is on our website. We'll be sharing the PowerPoint slides after the presentation, so you can click on this link or you can go directly to our website and find this form. But really what this form is just a confidential, snapshot of what you are intending or have already outlined in your will or trust to leave to CTU through your estate plans. Why do we need this? Why should you fill this out? You've already worked with your attorney and your accountant. You've already done all of the paperwork. Why does CTU need this form? Having this, again, allows us to kind of fit hand in glove with your plans. It also allows CTU to plan for the future. When we know that donors have made these kind of meaningful and sacred gifts to CTU, we can better plan for what the future of CTU may look like. Knowing where a gift may be designated or what areas it will go to support helps us to continue to, sort of educate our our wonderful theologians, and further the mission of CTU. So by letting us know, right, it's both kind of, it's nice for you, you get to let us know. We are able to meaningfully thank you during your lifetime. And for us, it allows us to really continue to plan for the future and keep pushing CTU forward, as we continue to sort of minister and form ministers, right, for the future of the church. The other part about letting us know, is, again, it allows us to meaningfully thank you for your generosity. I say this to my colleagues all the time. It is, in my opinion, one of the most humbling and one of the most sacred parts of my job at CTU is being able to thank people for gifts that we will not receive until they have passed on, at which point we are unable to thank them. Being able to do that during someone's lifetime and acknowledge them and share, their stories and learn from them why they're wanting to include CTU and create that lasting legacy. It's it's just, life-giving, right? It fills my cup, and I find it to be just so deeply, deeply sacred. And we want to be able to do that with you. And so letting us know provides us that opportunity. If we don't know, we can't. And then, it's just very sad when we find out that we've been included so meaningfully in someone's estate and we never had the opportunity to acknowledge that and to thank them. So sharing this form with us allows us to do both of those things. Again, recognizing estate plans are very personal, they're very private. This form and any information that you share with us is held in the strictest, confidentiality. This is not shared, but it does just allow us to, again, be planning partners and to meaningfully thank you. And with that, we have hit the end of the presentation. I hope you found this to be helpful and informative. If you have any questions, please do not hesitate to reach out to me, to my colleague, Patrick, or you can find us online at ctu.edu. You can also reach out to our general development inbox. It's devoffice@ctu.edu, and that will allow us to answer any and all of your questions.